The very warm introduction, and also thanks to yourself and the entire team at City Gold Bullion for giving me the opportunity to come up to Brisbane and talk tonight about why saving in bullion is likely to be the best decision that we can make with our money for the foreseeable future. As Nathan mentioned, I was very fortunate to get involved in the precious metal industry about 10 years ago when I was over in the UK. Bullion obviously was substantially cheaper back then. I can remember picking up silver for about $5, $4 the first time around. And obviously, despite the pullback that we've seen over the last 18 months, that is making a lot of people quite nervous, it's been an incredibly exciting and profitable place to invest. And I genuinely do believe, with all of the research that I've done and the people that I follow, that the next 10 years are going to be even more profitable for those of us that are already investors in bullion, or those of us who are looking to invest in bullion, which is something to be excited about, even if the reasons for bullion going up aren't necessarily so fantastic, because they're obviously intrinsically linked to the challenges that we still face in the global economy. And really, in a nutshell, there's a couple of questions that I want to ask everybody in the audience tonight, which I think really help appreciate or help us understand why we should be investors in bullion in a time, or at times like today. And the first of those questions is, put your hands up, just anyone in the room, if you really think you can spend more money than you earn forever, and that's the way to get ahead in life. Does anyone really think that they can do that? Yeah, unless you're a Keynesian economist, of course the answer is no, right? We all realise that we need to actually spend less than that we earn, and that it's a good idea to save some of our money so that we can either have that around for a rainy day, or so that we can actually invest it and build wealth over the medium to long term. Second question I've got for you guys, and please put your hands up and keep them up. Does anybody have private health insurance or home and contents insurance to insure their home? Put your hands up if you do and keep them up. Okay, great. Now, I want you to keep them up if you really hope that your house burns down or you get sick so you can claim on your insurance. So, someone's got their hand up still. Great. I'm Italian, I'll send some cousins around later. Look, the reality is that we don't buy insurance because we want something bad to happen, but we do take it because we want to protect ourselves against what, a very, very bad outcome, as talking about private health or housing before. But that's exactly why I started buying bullion 10 years ago, because it was very clear that there were a lot of risks in the global economy, and that we were actually going to just keep trying to kick the can down the road and make things worse. And that's exactly what's played out over the last 10 years, and what I believe will continue to play out over the next 10 years or so. And and I'm essentially going to explain why, by going through a number of topics across the better part of the next hour. But before I do, just as a quick disclaimer, obviously everything that we're discussing here tonight is purely educational in nature. It's not financial advice, so I hope you guys all find it very informative, but please don't go and act purely off what you have heard here today. And with that out of the way, the topics that I'm going to be discussing tonight, to help everyone appreciate why investing in bullion is a good idea, or starting to invest if you haven't already got any money there, is basically start by looking at the GFC and the unresolved challenges facing the developed world. I want to talk a little bit about the outlook for investing in traditional assets today, the importance of saving and why gold is a savings asset. That'll obviously follow into why the bull market in precious metals, both gold and silver, is really unlikely to be over. And then I'm going to touch a little bit about why I set up a self-managed super fund as a way of being able to invest in physical precious metals. So let's start by addressing what is really the elephant in the room when it comes to the global economy, and that is the amount of debt that we have floating around. And this chart, which goes all the way back to the 1900, uses the United States as an example. And a lot of the information I'm going to be using tonight actually focuses on the US. There's a number of reasons for that. The first is the quality of data going back a long way from the US is far superior to what we can get elsewhere. So it helps to understand where we are in the economic cycle the further we can go back in time and look at what was going on. Second reason is that the US is still by far the biggest economic player in the globe. They account for roughly 1/4 of global GDP. So obviously anything that happens in the US is going to have a cascading effect all around the world. And last but by no means least, the US is actually a great proxy for what is going on all around the developed world. So when we understand the challenges that they face, we pretty much understand the challenges that Western Europe, the United Kingdom, Japan, and even us here in Australia are facing. And what you can see when you look at this chart is that there have been two periods over the last 110, 120 years where as a society we have gone way too far into debt, we've borrowed too much, we've spent too much, and we end up with these huge imbalances in the economy. And the first of those, which you can see that peak back there when debt got to about 300% of GDP, was the late 1920s and early 1930s, which everyone knows as a period of the Great Depression. Unemployment rate went to well over 25%. The stock market crashed by the better part of 90%. Bottom line was that people that didn't protect their wealth through investments like precious metals saw their standards of living fall quite significantly. The second period of excessive debt build-up, excessive leverage, excessive spending is pretty clearly the one that we are living in today, which, as you can see, we've been building towards almost uninterrupted since the 1970s. Spending and using debt to fund it is what has allowed us to basically improve our standards of living over the last 30 years. It's not that we've been out earning more income or that we've been producing more goods and services. We've simply borrowed all of this consumption from the future. And what a chart like this should also help to understand, or help people understand, is that when the GFC happened, a lot of people were looking for a reason why. And we heard excuses. It was Goldman Sachs and JP Morgan being greedy. Yeah, that's true. It was subprime loans in the US. Yes, that's true. A few silly economic policies by the Bush administration. Yeah, that's true as well. But all of those things were merely the straw that broke the camel's back. The GFC occurred because for 5 decades we were spending too much and just going further into debt. And basically that was when the house of cards fell over. And what you can see in the sort of 4 or 5 years since the GFC occurred is that we've seen a slight pullback in the aggregate amount of debt that we owe, but not by very much at all. What's basically happened in the last 4 years is companies have repaired their balance sheets to a large extent. Individuals have certainly stopped using credit cards to the same extent that they used to. But we've seen an explosion in the US, for example, in student debt, and all around the world we've seen an explosion in government debt. They've been the ones that have been spending unprecedented sums of money in the last 5 years to try and keep the global economy ticking along. But as we all know, or as common sense would dictate to us, a problem caused by 5 decades of too much spending and too much debt is not going to be solved in 5 years alone, especially when the answer has been to just try and kick the can down the road and go even further into debt. There's a number of challenges though that we're facing today, or that we continue to face today, that make things even more challenging potentially than what occurred during the Great Depression. First of those, which you can tell from looking at this chart, is that the aggregate amount that we owe relative to what we're producing is higher now. You can just see that from looking at that. So the size of the imbalances in our economy are actually worse today than what they were 80 or 90 years ago. But the second and third challenges are even more concerning and are going to be even more difficult to address. And the first of those is the ageing population, which is a phenomena that we are seeing all around the entire developed world. And a couple of charts will really help explain how serious that challenge is. This first slide is actually uses Australian data, but you could pretty much draw a very similar graph for Japan, for the United Kingdom, for all of Western Europe, for the United States as well. And what it shows, going all the way back to 1965 and projected out to 2050, is the number of workers for every dependent there is in society. And obviously the more workers we have generating growth and paying taxes into the system relative to the number of people that are needing benefits from the system, the better it is in terms of the amount of economic output we can actually generate. And what you can see from the 1960s basically through to 2010, we were in what was basically a demographic sweet spot. So we had more and more people entering the workforce and less people proportionally needing to take benefits out of the system, as it were. But as you can see, almost right about the time the GFC hit, a couple of years later, we reached an inflection point. And going forward, we're going to have less and less people actually working and generating wealth. It means our output is going to fall. And we're going to have more and more people actually needing to take benefits out of the system, Social Security, Medicare and the like. And this is a serious problem that we're fundamentally unprepared for. In terms of understanding how serious that challenge is as it pertains to Social Security, Back in the 1950s, there was basically 16 workers for every one retiree. So if you imagine that a retiree has been promised $100 a week in social security or free medical care, let's say that's what the cost was. Back in the 1950s, each and every worker had to basically find $5 plus change every week, and grandma or grandpa was looked after as they had been promised. But wind the clock forward to basically 2005, and that number had dropped to barely 3 workers for every one retiree. So now that $100 that needs to be provided, each and every one of us that's paying tax, we've got to find over $30 each to keep the people who are requiring benefits from the government, to keep them in the manner that they've been accustomed to. And going forward, that's going to drop to about 2 workers for every retiree, because we're obviously living a lot longer and we're having far less children as a society. This is fundamentally unsustainable, and we've done nothing to address it all around the developed world, because it is a political time bomb to try and change the structure of social security. And in terms of the kind of numbers, because a lot of people see these things and they go, oh, I don't understand how profound it's going to be. The Government Accountability Office in the United States, they actually did a projection from 2007 to 2032 on how much they thought GDP would grow versus some of these social security items and Medicare and the like. And they projected that GDP would grow by about 71% across that period. But the cost of social security was basically going to grow at double that rate, about 127%, whilst the growth of Medicaid and Medicare was going to grow at basically 3 times the rate of the overall economy. Now, these are not small ticket items on government budgets on a yearly basis. In the US, non-discretionary spending on items like this, plus interest on the national debt, basically already accounts for every single dollar of tax revenue that they take in. And it's going to grow, as I say, 2 to 3 times the pace of the overall economy going forward. So there's absolutely no way that it can be sustained in its current format. So you've either got to raise taxes enormously, which is politically unpopular and will also detract from growth, or you've got to say to people, guys, we know you've paid taxes your whole life, we know we've promised you all of these benefits, but actually we can't afford them. And there's no way you get elected into democratic office trying to do that today. And that leads to the biggest difference between the challenges that we face today and the challenges that were faced by society when the Great Depression hit over 80, 90 years ago. And that is the role of the government in our society, because back then, government spending was only 6 or 7% of GDP. And government debt was basically a non-factor. So all of that debt that I showed on that earlier chart, that was basically us as individuals and businesses. We were the ones that had racked up that debt. But this time around, individuals are in too much debt, businesses are in too much debt, and governments are in too much debt as well. And how have they done that? Well, they've done it the same way we have, by 50 years of spending too much money. Now, in the last 5 years, what have we heard? All around the world, we've heard GFC hits, private sector's contracting, government needs to spend more money to try and keep the economy going along. That's basically what we've heard all around the world. Even here in Australia, we've heard it. Which would kind of make sense if governments had been running surpluses during the good times so that they could stimulate the economy during the bad times. But let's actually have a look at what the government has been doing all the way back to 1960. And the way that I express government debt as a general rule is looking at the deficit as a percentage of the revenue. Most economists will talk about government debt as a percentage of GDP. But the government doesn't own the GDP of the nation. We do. We're the ones that are out there working. They can only service their debt with the tax revenue that they take from us. So the better way to look at government debt as a general rule is how much money are they spending versus how much money are they taking in tax on an annual basis. And let's have a look at what they've been doing since the 1960s, starting with the Kennedy administration, then Lyndon Johnson and the appointment of Richard Nixon. We can see they ran deficits every single year since the 1960s. Nixon takes the US off the gold standard, Watergate happens, I think Jimmy Carter comes in after that. They run deficits basically every single year. After Carter comes Reagan, and followed by Reagan was George Bush Senior. Now, Republicans love saying that it's the Democrats that always spend too much money and that they're the party of fiscal rectitude, but actually have a look at what they did during the 1980s. You can see that they ran unprecedented deficits to that time. And then Bill Clinton gets elected with that famous "It's the economy, stupid" tagline. Wins, stays in office for 8 years. Then George Bush Jr. gets elected. The Iraq War happens, the NASDAQ crash, you name it, and ultimately the GFC. And at this point, so Clinton actually did run a couple of surpluses for a while there, but at this point, once the GFC occurred, the American people were pretty fed up. They were looking for change. They realised that there were some problems. And there were politicians who were willing to offer it to them. And I'm going to read this word for word because I really think it actually is worth paying a bit of attention to. This is a speech from at the time, Chicago senator. The fact we are here today to debate raising America's debt limit is a sign of leadership failure. It is a sign that the US government can't pay its own bills. Over the past 5 years, our federal debt has increased by 3.5 trillion to 8.6 trillion. That is trillion with a T. That is money we've borrowed from Social Security, borrowed from China and Japan, and borrowed from American taxpayers. Leadership means the buck stops here. Instead, Washington shifts the burden of bad choices today onto the backs of our children and grandchildren. America has a debt problem and a failure of leadership. Americans deserve better. I therefore intend to oppose the effort to increase America's debt limit. I therefore intend to oppose the effort to increase America's debt limit. Fantastic speech and good enough to get you elected President of the United States. That was Barack Obama 5 years ago. And since he got into office, this is what he's done. He has run the biggest deficits that we have ever seen in human history, on average well over $1 trillion each and every year. As I'm sure a lot of you guys would have seen the YouTube clips, but $1 trillion is such that if you'd have spent $1 million a day from the day Jesus was born and you were standing here tonight, you would still not have spent $1 trillion. And they owe $17 trillion, or roughly $150,000 for each and every American that actually has a job. And the median American income is about $25,000 a year. That's the scale of the challenge as it stands today. And in terms of how we're paying for it now, that red line at the bottom is the US money supply. That's why we're printing money now, guys. There's no way for governments to issue the debt and keep the economy going, as it were, without merely printing money. Now, I could sit here and spend 3 hours talking about printed money and currency failure and all that kind of stuff. Or I could talk about what's happening in Venezuela or countries like that today where they're printing on an epic scale and how society is getting poorer and poorer because it is a dead-end policy. But I'm not going to do that. I'm actually going to show you guys a short video which I think accurately sums up what printing money really is and how dangerous it is.
Now, you're an economist working in the banking sector, yeah?
I am. Should I get a lawyer? I think I'm entitled to legal representation.
No, this is just a few simple questions.
Simple questions?
Yeah.
How simple?
Well, they're theoretical.
Theoretical. I can deal, okay, we can deal with that. I mean, don't hold me to the answers, but...
Why not?
Well, because I'm an economist and I can think of a different set of circumstances under which my responses might vary somewhat.
Everything's connected to everything else.
In economics, I'm afraid that is the global fear right at the moment. Yeah.
Now, right, there's a lot of uncertainty in world economics.
There is a great deal of uncertainty and a lack of confidence.
Yeah, and there's a lot of talk of quantitative easing.
Quantitative
That's a term
easing,
we hear all the time.
That's a term you hear a lot at the moment, yes.
Yeah, what exactly is quantitative easing?
Well, I can answer this because actually we're advising a couple of governments about this right at the moment.
And what are you saying to them?
Well, perhaps I should just take you through what we're telling them to do.
Yeah, sure.
I mean, I won't go into a lot of detail, that'll be indiscreet, but this will give you an idea of how quantitative easing works.
Yeah.
Take printer out of box and place on table with the out tray facing the window.
The out tray facing the window.
That's right. Load paper into the paper receptacle and place currency on glass tray F.
Right.
Check alignment by printing out a test page.
Right.
Go into copy settings and select double-sided and the number of copies you require.
How many would you suggest?
In the case of one of our clients, it's 80 billion, 120 billion. In the case of another client, one client wants 1 trillion of these things.
Can you get printers to do that?
No, you can't. You're going to need a bank of them. I mean, it's a multi-printer
big
job.
ones.
Yeah, big industrial stream. Yeah. Big like a Bofors gun, all facing the window. So once you've ascertained that you have the alignment correct, you alert the banking sector, open the window, and press copy.
And stand well back.
Yes, you've got to stand well back because they can create a bit of a vacuum while reaching cruising height.
What about?
In the super fund industry very often.
And you'd have to consider the wind direction too.
Well, yeah, you don't want to be doing this upwind.
No, because you'd be covered in pretend money, couldn't you?
Covered in what?
Pretend money.
No, this is not pretend money. This is real currency we're creating.
Why aren't you just printing it off? I mean, these are photocopies, aren't they?
Excuse me. Dave, this is not going to work. Because I just explained it to a bloke and he saw through it straight away. He's not even in the banking record. Okay, I'll try that. Try one. Have you ever heard of Rumpelstiltskin? Good. Now we're getting somewhere. Put up a chair. I'll tell you a tale.
Look, it's obviously a very humorous video, and those guys have got some great videos, not just on quantitative easing, but banking and you name it. And I highly recommend anyone who's got a few free minutes to spend some time on YouTube looking at them. But there's a really serious message in there, guys, and that's the bit where he picks up the phone and he goes, "It's not going to work." Bottom line is, the process that we're undertaking right now is just adding to the imbalances in the economy. It adds to the risk that we face as investors. Sorry. Yeah, sure. So basically, apologies for that. So what we're facing is a scenario where, as I say, risk in the economy, risk as an investor is only getting worse. And despite the fact that governments are saying, "Oh, look, we'll get our act together soon, we'll stop running deficits, ASAP as soon as the economy recovers," there's actually no plan at all for them to stop running deficits and to stop going further into debt. This chart comes from the Congressional Budget Office, and what it shows, if you look at that dark green line, that's spending every year out to 2038. They actually have one that goes to 2088 that looks exactly the same. The line below it is revenue. Every single year from now, as far out into the future as they are willing to project, they plan on spending more money than what they plan on taking in revenue. It's not even that they don't plan on paying $1 of debt back. They actually plan on going further into debt as far as the eye can see. Now, we all know that that can't happen, because the only way it's going to be done is if we continue to print money. And as the video said, that is not going to work either. So we need to be really, really careful, because governments are just making this problem worse. And not only them, but central bankers are absolutely facilitating them in that process by being the ones that are willing to hit the print button. And it's really interesting, because a lot of people are very sceptical of government spending and the way governments interact and tax and you name it. But central bankers for now, at least in broader society, have basically gotten through the last 5 years largely unscathed in terms of the public opinion of what they are up to. I think this next magazine cover really accurately sums it up. That's Ben Bernanke there with a headline of "The Hero." And it says, "Ben Bernanke saved the global economy." So why does everybody hate him? Which is a strange title, because everyone in the financial sector absolutely loves the guy. But is this guy really a hero? I mean, let's have a look at what this guy has said over the last 5 years. And it's not just him, it's his central banking counterparts all over the world. I'm sure he's a pleasant enough individual, but should we have all of our faith in a man like this to generate a genuine economic recovery for us? I don't believe so. This is what he has said over the last few years. He was asked whether or not US house prices would fall back in 2005, and he said, "I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis." 100% wrong. House prices crashed within a couple of years. Next one. "The impact on the broader economy and the financial markets of the problems in subprime seem likely to be contained." That was March 2007. Early 2008, "The Federal Reserve is not currently forecasting a recession. Within 1 year, they go into the biggest recession since World War II. Another one from later 2008, "The GSEs," that's Fannie Mae and Freddie Mac, "are adequately capitalised. They are in no danger of failing. Within months, they were nationalised because they were going to go under." And last but by no means least, "The Federal Reserve will not monetise the debt," i.e. will not print money. Wrong on every single level. Now, as I said, I'm sure he's a decent enough guy, and at the end of the day, he is tasked with an impossible job. But as individuals, we've got to take steps to protect our own wealth, because it's really not a very smart idea to put all of our faith and all of our assets behind someone or behind an institution that has such a questionable track record as an economic forecaster. And the reality is, despite all these efforts of printed money, and despite the amount of government debt that we have generated or gone into over the last 5 years, we're actually not getting any kind of sustainable economic recovery. This shows global GDP all the way back to 1998. And you can see that we had a fairly large fall when the GFC occurred, a pickup after that, but since basically 2010, growth has been trending down. I mean, on any given day, there's hundreds of economic data points that are released: retail sales, inflation, unemployment, industrial production, and all of those are interesting points, but a lot of times it's just noise. GDP growth is where we could really tell if we were getting some kind of sustainable economic recovery. But what you can see is that despite all of this additional debt, despite all of this money being printed, we are getting less and less bang for our buck as we speak. I was just checking the news 10 minutes ago. France just released some figures and it looks like they're going back into recession again. So the idea that we are on the verge of some sustainable global recovery and that governments will be able to trim deficits, that the Federal Reserve, the ECB, the Bank of England are going to be able to stop printing money is fanciful when you look at the real data in terms of what is going on in the global economy. And as Nathan said earlier, we are not immune from this in Australia. The one thing that has kept us out of recession in Australia in the last 5 years since the GFC hit has been our mining industry. Now, everyone knows that we've been in a mining boom. You hear that on the front page of the newspaper all the time. But in terms of understanding how significant it has been, this chart shows mining investment as a percentage of GDP going all the way back to the 1950s. It tended to be 1 or 2% of GDP. In the last 5 years alone, it's grown from basically 4% to over 8% of GDP, single-handedly keeping our economy out of recession. The other thing that really helped us in the last 10 years, not just the last 5, was the fact that prices for iron ore, coal, gold originally as well, and natural gas went up as far as they did. What that meant was that for a given quantity of exports, we were never in our history were we able to afford more in terms of what we could import. Treasury forecasted that it accounted for basically 50% of national income growth in the last 10 years. That's how important mining's been to our economy. Was it not for that, it wasn't Kevin Rudd's $900 handouts, it wasn't what the Labor government did post-GFC to try and stimulate the economy. Mining is what saved us from basically following the rest of the world into the GFC, but the glory days of it are past, in the sense that we're still going to have a healthy mining industry, but mining capex has peaked, it's now coming down the other way, and our terms of trade are starting to fall as well. And whilst there's this great hope that we're going to see some housing boom in terms of construction, or Australians are going to go out and spend a whole heap more money and get their credit cards out again, that is really, really, really unlikely, because we have a debt problem all of our own in this country too. And that's why the question is Australia really a low debt nation? Well, if we look just at our government debt, you could say the answer is yes, because we only owe about 20% of GDP. Countries like Italy, Greece, Canada, the US, it's over 100% as a general rule. But as I said earlier, the government's share of the economy is all it can take in taxation. And in terms of how it services its debt, it has to get the money from us in the first place. So the amount of money that we owe, or the amount of money that businesses owe, is hugely important in terms of how much debt the government itself can have. And when you add in financial sector debt, non-financial sector debt, and the big one in Australia, household debt, you can see that the aggregate amount of money we owe relative to what we're producing is not entirely dissimilar to countries like Greece, countries like the US, countries like France. So we have a debt problem all of our own in this nation. It just happens to be more of a private sector debt burden, most of which has been funneled into our housing market, of course. So the idea that Australians are going to go and spend up big is highly unlikely. In fact, credit card balances in this nation, the aggregate amount that people owe on their plastic, is actually falling, because Australians have realised the good times are over and it's time to hold on to your money and be a little bit more cautious. So summarising where Australia is, we've, as I said, have an over-reliance on one industry, mining, which is now in decline. We have a significant private sector debt burden. Business conditions all around the country are back towards GFC levels. Confidence in business has picked up a little bit since the election, but actual business conditions are still very, very poor. That translates into how much they plan on spending or investing and how much they plan on hiring. Very few businesses are planning on hiring and adding staff, which is leading to unemployment rising. And if we get a lower Australian dollar, which is the great desire of the Reserve Bank and the government, we're all going to face higher inflation, because everything that we import is basically going to go up in costs. And last but by no means least, Australians have little in the way of cash flow. You might hear in the mainstream media that we have a 10% savings rate. 9.5% of that is superannuation. Unless you're retired, you can't touch that. So most Aussies actually have very, very little in the way of free cash flow to go out and spend. So you add all of this up, you add this debt problem that's getting worse, a demographic and ageing population crisis which we're in no way dealing with, governments that are spending money like they never have, central banks printing money out of control, and GDP growth around the world actually very, very weak. And it is an incredibly important time to reassess where your investments are and to make sure that you're protecting your capital. Because let's be honest, gold's not the only option that we've got as investors. There's cash, there's equities, there's bonds, and there's property. So let's have a think about whether or not these are cheap assets to invest in right now, and whether or not it's a sensible idea to be pouring more capital into these things before we look at gold. Starting with cash, I'll talk about that a little bit more later, but suffice to say, interest rates are at record lows and may well go lower next year. So never have you earned less by just keeping your money in a bank account. How about equities? Well, equity prices, especially when you add dividends back in, are basically at all-time highs or very close to all-time highs, at least in nominal terms, all around the world. Even in Australia, when you add dividends back in, basically the ASX is back above where it was when the GFC occurred. Such has been the rally in the last couple of years. But let's think about the valuation in equity markets. And what this chart shows, this goes all the way back to 1880, and it shows the S&P 500 price-earnings ratio. Now, for anyone that's not familiar with what a price earnings or a PE ratio is, basically what you do is you get the price of a company. Let's say it's trading at $100 a share. And let's say they're earning $10 a share in any given year, then the PE ratio is 10 for that company. If you get every single company on the market, get all of their earnings and the prices of all of those companies, you can calculate a price earnings ratio for the market as a whole. And that is exactly what this chart does. And it goes all the way back to 1880. And you can see that on average, investors have generally been happy paying about 15 times earnings to be owners of stocks. But of course, there are periods of extreme optimism in the market where people end up, they're willing to pay much, much higher prices for stocks. And there are periods of extreme pessimism in the market where people don't want to own stocks no matter about the fact that they're very, very cheap. As you can see where we are today, with a market PE ratio at about 25 times, stocks have only ever been this expensively valued a number of times throughout, only 3 or 4 times throughout history. And in terms of what has happened over the previous times that the market was this expensive, well, we've seen losses of 70%, losses of 80%, and losses of 60% from valuations of these levels. Warren Buffett himself a couple of weeks ago was interviewed and he said, we're finding it really hard to find things to buy because the market's not cheap. Now that doesn't mean you shouldn't have any money in equities, but the idea that you should just put all of your money into the stock market when valuations are already this extreme is something we should be really, really concerned about. Moving on to the bond market, this goes all the way back 200 years, this chart, and it shows US Treasury 10-year yields. And what you can see, obviously, yields and price are the opposite of each other, so the lower the yields, the higher the prices are. And you can see that we have been in a bull market for bonds for the better part of 30 years. And yields today, not just in the US, but pretty much all around the world, have never ever been lower, i.e. prices have never ever been higher, despite the fact that the institutions issuing this debt, these bonds, have never been further in debt themselves. So you're basically taking the maximum possible risk for the minimum possible return, which is the exact opposite of what a sensible investor would generally choose to do.
Were you calling that a bull market or a bear market?
It's been a bull market for the last 30 years because yields have fallen, i.e. prices have risen.
Okay.
Yeah, great. And last but by no means least, Australia's favourite obsession, which is of course investing in housing. And this market this chart goes back to 1987, and you can see housing prices versus the UK and the US. And you can see that in Australia, we've never had any major correction in this country, which makes people very complacent that we'll never have one. But that is exactly what the US thought 5 years ago. It's exactly what the Spanish, the UK, the Irish, basically what the Japanese thought 20 years ago when their housing market imploded. I'm not saying that that's going to happen in this country, but the idea that we're about to see a sustainable bull market in property from here when valuations are already so extreme is highly unlikely. And not only that, it's different if you're a home buyer just wanting to buy a house to live in, but from an investor's point of view, the gross yield that you're getting in property is only about 4% today. That's gross before you've even paid any costs. So you can get that in a term deposit today, even with rates as low as they are. So again, you're basically paying the highest possible price you ever have to be an investor in property to get the lowest possible return that you pretty much have. Add all that together, that's not necessarily the greatest way to invest all of your portfolio. So when we sum up the economic fundamentals that and the economic situation around the world and the investing climate that we're in, it's pretty safe to say that the global economy is in worse shape than it was 5 years ago when the GFC hit. There are significant headwinds that we are yet to tackle. Governments and central banks are not really interested in solving the problem. They're kicking the can down the road and they are making it worse. Despite that, right now, asset markets generally all around the world are at or very close to all-time highs, whilst the return you're getting for being an investor in those assets, should you choose to buy them instead of gold or sell your gold to buy another asset, is basically close to all-time lows. So when you sum it up, as I said before, you are taking the highest level of risk for the lowest possible return, or the lowest historical return, being an investor today. Now, the flip side of being in an environment where there's never been more risk as an investor is that there's never been a better time to just be a saver of capital. Because if you can hold on to your capital in environments where other people are losing money, then you do very, very well, because you've got your assets intact so that when the dust has settled, so to speak, you can go and purchase and invest. If you've got $100,000 and the guy next to you has $100,000 as well, and he loses 50-60% of his capital, and that's what most people do, even if you don't make a cent, you're still doing far better than what everyone else is doing. And that's why there's such power in saving in an environment like in an environment like the one we are in now. And that's pretty much what Warren was, I think, trying to get to when he said his rules of investing. He only had two. Rule number one, never lose money. Rule number two, never forget rule number one. It's not always about trying to invest to grow wealth. Sometimes the smartest thing to do is just to make sure you're protecting your capital and not subjecting it to the kind of risks that are out there in the marketplace today. And ultimately, when it comes down to it, guys, well, how do we save? We save in money. That's the medium that we choose to save in. And we've got two choices in today's world. Normally we only have one. Gold and silver are generally are money. They are what we use as money. They have been, for over 90% of recorded human history. But in the environment that we're in today, we've got two choices. We can save in paper money in a bank account, or we can still choose to save in physical gold and silver. And if we look at what's happened over the last 40 years, since we went off the gold standard, you can see that this is basically if you bought an ounce of gold at the average price every year for the last 40 years, or if instead of doing that you'd put your money in a bank account, this is what you basically would have ended up in. Paper money has gone up by 6% per annum, gold's gone up by the better part of 10% per annum across the last 40 years. But obviously it's not as simple as that, because there have been periods where it's been better to be in paper and periods where it's been better to be in gold. And if we're all being honest, I'm sure we'd love to be able to save in paper money if we could get a solid rate of return and we weren't subject to huge inflation risk. We would prefer not to have to take the risk or the volatility risk that gold and silver do offer. So what we need to do as savers is say, well, in what environment does it make sense to be in gold and silver versus keeping our money just in a bank account? And you can see pretty clearly that gold excels exactly in a time like we're in today. When real interest rates, i.e. what you can get in a bank account, are 2 or 3% or higher, then gold and silver quite naturally do quite poorly, because people say, hang on, why would I hold on to this metal that's not going to pay me an income and which is volatile in price when I can safely store my money in a bank and get 3, 4, 5% real rate of return? That's a perfectly logical thing for an investor to do. But in environments where real interest rates are only 1 or 2% or even negative, as you can see, gold and silver prices tend to go up by 10% per annum or more, because the only reason interest rates ever get that low or negative in real terms is because there is such risk in the economy and investing in traditional assets. And obviously you can't save in a bank account because interest rates are basically negative. So more and more people look to put their money in precious metals. That is exactly the environment that we've been in the last 10 years pretty much, and it is exactly the environment that we're going to be in and remain in for the foreseeable future. And the reason for that is that society is so far in debt now that we cannot afford interest rates to normalise. This again goes back looking at the US government. And if we look at where we are today, the US government owes $17 trillion and they take in about $2.8 trillion in tax revenue. Borrowing rates roughly 2.2%, meaning every year they spend $376 billion in interest expenses only, or roughly 13% of their taxation revenue. By 2017, they're probably going to be, at the very best case, 20.8, nearly $21 trillion in debt. By then, tax revenue is projected to be $3 trillion. Now, if interest rates went back to 6%, which is merely the long-term average, so we're not talking some catastrophically high figure like there was in the late 80s, then the US government would be spending $1.25 trillion a year just servicing the interest on the national debt. That's 40% of their tax revenue. How on earth are they going to pay for Social Security, for Medicare, for all of those things that are going to be growing as fast as they are in the coming years? There's absolutely no way that that can happen, and that's why interest rates have to stay low, not just in the US, but all around the world. So central banks will keep rates at or very, very close to zero to keep the short end of the yield curve low, and they'll keep printing money so that bond yields don't go much higher, because governments simply cannot afford for borrowing costs to go higher in any meaningful way. Basically meaning that for the foreseeable future, cash is not going to be an asset that you are going to be able to save in anything other than the short term. In the short term, fine, but if you're trying to save over a 3, 5, 10 year period, cash in a bank is basically not going to do it for you anymore. A lot of people say though, well, why gold? Why would I save in gold? What's so different about gold to copper or wheat or any other commodity? And the reality is, why you guys should be saving in gold, or why we should continue to save in gold, is that gold is a monetary asset, not a commodity like all of these other things. And the reason for that's pretty simple, and it comes down to, why do we value commodities at all? Well, we value commodities like oil because we can use it to fuel a car or make plastics, amongst 100 other things. We value wheat because we can turn it into pasta or into bread. We consume it. We value copper because we use it for copper wiring or 1,000 other industrial applications. Meaning that all of these commodities, generally speaking, what we produce in 1 year, we consume in 1 year. And what that leads to is a situation where they have a stock to flow ratio at or about 1. Stock is the existing stockpile, flow is the annual production. And because we're basically producing and consuming more or less the same amount in every year, those two, that number stays around 1. Gold is completely different to that. Gold is pretty much useless from an industrial perspective. Very, very little of the gold that's ever been produced or mined has ever been actually consumed in an industrial sense. Well over 90% of it has just constantly been stored. We just add to the existing stockpile of bullion that we have in the world. That's why today there's roughly 170,000 tonnes of gold known to be in existence, and roughly 2,800 tonnes a year gets produced, meaning we're only adding about 1% to the existing stockpile of bullion on an annual basis. And that's really important for people to understand that, because what gives gold its value as a monetary asset is not the fact that it's scarce, because all commodities are scarce. What gives it its value as a monetary asset is that the overall supply is fundamentally stable, and that supply cannot be altered in any meaningful way. We're just going to constantly keep mining it and constantly adding incrementally to the supply of bullion. This is something that we have built towards over thousands of years, and it is not able to be changed in any meaningful way going forward. And it's probably best summed up. There's 100 quotes. You could look at Churchill, de Gaulle, you name it, any Greenspan as well, who have got fantastic quotes understanding what bullion is. But my personal favourite is this one, and it came from a gentleman by the name of Albert Gallatin. He's the longest serving US Treasury Secretary. And as he said, nations differing in language, religion, habits, and on almost every other subject susceptible of doubt have, during a period of near 4,000 years, agreed in one respect, that gold and silver have, uninterruptedly to this day, continued to be the universal currency of the commercial and civilised world. Now, if you think about this, Marco Polo went to Asia in the 1300s. I think Columbus discovered the Americas 1492. Well before people that were living in Asia even knew that Africa existed, well before people in South America even knew that there was a Europe, societies in all of these places basically built market-based economies all around some kind of gold standard. Not because gold is magic, but because it has the best qualities as a monetary medium and as a savings vehicle. And that is absolutely unchangeable now. It doesn't matter that we've chosen in the short term from 1971 to say, no, we're not going to use gold anymore, we're going to use paper. Society has tried that hundreds of times to move from gold to paper. We've always failed at it because paper money is basically able to be created out of thin air, and we always go back to some form of gold standard. And it's something that people today understand very, very well. This next gentleman that I want to show a couple of quotes from, he's actually a Brisbane boy, I believe. His name's Matthew McLennan. He is a managing director of a company called First Eagle Funds, and he's based out of New York, and he manages $80 billion in money for his clients. And he's by no means a gold bug. He's got plenty of money in equities. In fact, he's got the lion's share of his clients' money in equities. But he has these comments to say about gold. The paradox of gold is that its utility as a monetary reserve is its uselessness as a commodity. It outlasts corporate fads and sovereign regimes. It's just reinforcing that point that gold is not a commodity, it is a monetary savings asset that you can be sure will be here long after any company may or may not go bust, or any government may or may not go bust. And in terms of why he invests client money into gold right now, despite the volatility, despite the fact it's fallen significantly this year, this is what he had to say. The allocation to gold is a hedge against the risk that the financial system breaks because it is not on a sustainable trajectory. Very, very simple. He can see the debt, he can see the demographic problem, he can see that governments aren't doing anything to fix it, and as he says about printing money, all we're doing is basically breaking the price mechanism that the market needs to work efficiently. He's not panicking, he's not a gold bug, but he's a very, very sensible manager of capital, saying it makes sense for me, on behalf of my clients, whose wealth I'm trying to protect, to have an allocation to physical precious metals in this environment. But despite that, guys, we all know that gold is not going to be a straight shot. Certainly anyone that's been an investor over the last couple of years will appreciate this. As I say, I've been lucky to be in this market for about 10 years, and this chart's great because it helps me appreciate that what we're going through right now, we've seen corrections along the way. Back in 03, 04, we saw a 15% correction. Back in 2006, gold actually fell by about 23%. Actually, for a few months during the GFC, we saw a 30% correction, and the one that we're going through right now, I know it's making people very, very nervous, but if you look at the last 10 years, none of the fundamentals have changed, and ultimately those corrections have actually been the best time to buy more bullion, because not only have those corrections ended, but prices have gone well beyond their previous high. And I think 3 years from now, 5 years from now, we'll be looking at this chart and we'll be thinking exactly the same thing, because bullion prices will be much higher, as I said, in my opinion, at the very least. And to help you guys, a lot of people, if they've read what they might have seen on Bloomberg or Reuters or more traditional financial media saying that gold was a bubble at $1,900 and it's bursting now, that's just fundamentally not accurate. There's a few different ways we can look at that, and I want to show you a couple of these to you guys today. This first one is my favourite, and what I want to suggest or point out to you guys is that right now, the global stock of financial assets is basically $225 trillion at last estimate. That's how much money is floating around the world invested in various asset classes. It's such a huge sum of money that it doesn't really make sense to anybody, right? But let's assume there was just $100 of investment capital floating around. How is that money invested as we stand today? Well, there's about $52 sitting in bonds, which, as I said, are offering the lowest historical returns, and you're taking the highest risk. The institutions issuing that debt have never been more indebted. There's about $37 sitting in equities or in the stock market, which, as I showed to you guys before, are expensively valued, at least in my opinion, and history would suggest, and are exposed to economic downturn. You've then got cash and alternatives. There's about $10 there. which are, as I said, you get record low interest rates and you suffer or you're exposed to inflation risk from money printing. And last but by no least, there's basically $1 in physical bullion, which is historically undervalued, at least for a number of metrics, which we'll look at next. And we're in the perfect macro environment for prices to appreciate, in the sense that interest rates are low, we're going to continue to print money, and our economies are not getting better in any meaningful way. A few other ways that we can look at why history suggests that gold is still cheap is if we were to do a real inflation adjustment. Again, mainstream media will say that a real inflation adjusted gold price peak from 1980 to today is only about $2,500. But I think a lot of people in the room would be very well aware that the way that inflation is measured has changed dramatically over the last 30 years. It is no longer an apples with apples comparison. If you were to do that, if you were to measure inflation the same way today as you did back then, gold prices would need to go above $8,000. If we were to see a repeat of the 1970s where gold went up 25 times, we'd expect to see prices around $6,000. If gold and gold mining companies reach 25% of global financial assets, not 1%, then we'd expect to see prices around $8,000. If they were to back the US money base, if the US gold reserves were to back the US money base like they did in 1980, then we would see the price well above $10,000 today. And last but by no means least, I'm sure many people in the room have seen, the Dow gold ratio. If we see that ratio back at 1 to 1, unless we have an equity market crash, we would expect gold prices to go well above $14,000. So with that in mind, it is absolutely crazy to think that gold is a bubble today. Not saying prices are necessarily going to go back to this level, but we shouldn't be panicking thinking, no, gold was definitely a bubble and I should have sold all my bullion at $1,900. And last but no means least, in terms of what's going to help push gold prices higher, is the role of emerging markets. Because what I've spoken about tonight has mostly been about the decline, for want of a better word, of what we might consider to be the developed market West, and the risks in our economies from too much debt and too much money printing. But the flip side of the bullion story is the rise of the East and the rise of emerging markets, particularly China and India as well. And what I've shown here is the tons of gold that Brazil, China, Russia and India hold, and the percentage that it makes up of their foreign exchange reserves today. These are the central banks of these countries. And you can see that they hold somewhere between 1 and 10% of their reserves in physical bullion. Now, traditionally wealthy nations have held the better part of 75% of their reserves in physical gold. If China, Brazil, Russia, India even were to move towards holding 20 or 30% of their reserves in physical bullion, they would need to buy well over 25,000 tonnes. Every single ounce of gold that will be mined for the next 10 years, pretty much. And it's not just their central banks, it's the citizens as well. They're actively promoting, in China, they are actively promoting citizens to come to buy gold now and to save in gold. This is an absolutely enormous tailwind to physical bullion that is going to be in place for the next 10 years. And as much as gold, we should buy gold to protect ourselves from the decline of our own economies, as it were, we should also be buying it to participate in the upside of all this wealth that is transferring from west to east as we speak. I want to make a comment about silver as well, because I know there'll be a lot of people that buy silver in the room tonight, and my thoughts on that. What I'll say is, we all need to acknowledge that the price is going to be significantly more volatile than gold, but in all likelihood more profitable as well, as it has been the last 10 years. It's also really important to acknowledge that it is a quasi-industrial metal, whereas gold is almost exclusively used as an investment asset. There is a huge percentage of silver's production actually goes towards industrial usage. Also, the fact that production is correlated to base metals. So whereas most gold that's mined is mined as primary mine, something like 70-80% I think now of silver is actually mined as a byproduct of other mines. So there's very few pure silver mines in the world. But despite that, I think everybody in the room, or many people in the room, would know that historically the ratio between these two metals has been around 15 or 20 to 1. Right now that ratio has blown out to the better part of 65 to 1. So if we saw gold prices go back to, say, $3,000, if that's a number that they went to, then we would see silver prices at about $150 if you were taking that kind of ratio. So whilst you might make 2.5 times your money in gold, you could make 6.5, 7 times your money in silver if we were to see that kind of historical mean reversion. So for those of us who have got the stomach for it, there is incredible opportunity in physical gold, but potentially even more opportunity in physical silver. And in terms of buying and storing your metals and the ways that you can do it, and I'm sure you've all got your own styles and there's no right or wrong way, but a number of options, or what we often talk to clients about. Some people just want to make a lump sum investment. They might have 200 grand, they go, you know what, I want 50,000 in bullion. They'll just buy it all in one go. Nothing wrong with that at all if that's the way you want to go about it. A lot of clients choose to dollar cost average, so that 50,000 they might go, actually, I'm going to buy it in 5 lots of $10,000. Or in particular with silver, we see a lot of people just making regular purchases. Whenever they've saved enough money to buy a kilo of silver, they just come in and buy that. There's no right or wrong way about it, but if you're sort of thinking, what am I going to do next in terms of buying bullion, or if it's the first time you're doing it, those are some of the things you can think about. And in terms of storing it, obviously you guys can store it at home, but we do have very, very competitive and believe well-priced professional storage solutions for you guys to think about, and at least then you don't have to worry about someone breaking in, although I remember the guy up the back's fine with that if that happens. But the last thing I want to talk about before finishing up tonight is the concept of using your superannuation to buy gold. I personally have an SMSF, and I just want to tell you guys a bit of a story about why I've set one up and why I am very happy with that decision. As I say, it's not necessarily going to be for everyone. I'm not saying it's, you should all rush out and do it. I can't give you that advice even if I wanted to. But I do want to talk a little bit about super, because it is such an important part of our financial well-being for Australians. And to sort of get everyone's eyes open, as it were, about superannuation and self-managed super, I thought I'd start with a quote from our newly elected Prime Minister, which he made on the 25th of September 1995 back in the House of Reps, where he said, "Compulsory superannuation is one of the biggest con jobs ever foisted by government on the Australian people." You will never hear him say that again, I am sure. Now, look, 20 years on, there was a fairly fantastic review that the CPA did into the state of the superannuation industry in Australia, and what they found was that it hadn't really in any meaningful way reduced the number of Australians, the percentage of Australians that were likely to require the aged pension in the future. That was the whole point of bringing in the superannuation industry. They said, we're never going to be able to afford the aged pension because of the ageing population, so let's force everybody to save, and that'll make them everyone will have their own pool of money. That hasn't really happened. What's more, and it's quite understandable, a lot of Australians have got quite complacent about their saving and about the amount of debt that they carry into retirement, because they think, oh, I've got this huge superannuation portfolio. So what we've seen is a large increase in the number of Australians that are retiring with a significant portion of debt, and we've also seen a huge decline in our savings rate ex-superannuation, because people are thinking, I don't need to worry about saving, I've got super, I'm fine. So the super industry, I'm a big supporter of it in theory. I think it's great that we have the opportunity to save and that there's tax advantages, but it's really important that we as individuals take a decent look at it rather than just relying on it all being okay. And as I said, I want to explain why I chose to set up a self-managed super fund so I could maximise my personal super. The first issue that I found with the super industry, and I came home just over 3 years ago to Australia and basically looked at this, was the scale of the industry. So right now it's $1.6 trillion, and it's going to grow to 7.6 trillion, they reckon, by 2030. 1.6 trillion as it stands today is already the same size as our entire economy. 1 year's worth of economic output. So when you've got your money in a huge fund that's got tens of thousands of members and they're managing $100 billion, it's almost impossible for them to beat the market because they're so big they are the market. So it's not that they're necessarily doing anything wrong or trying to do the wrong thing, but they're not. If you're managing $100,000 of your own money or a couple of $100,000, you can be a lot more flexible than what someone managing $100 billion can be. Second issue is the flexibility of the investment structure. I wanted to be able to buy physical precious metals with my retirement money. Couldn't do it through a traditional super fund. Made sense to me to go, okay, well, if I have an SMSF, that's one of the options that's available to me. And it's not just physical gold, there are other things you can do with an SMSF too. Concerns over the priorities of my super manager or advisor, I'll show a quick slide on that to explain that. the flat fee structure versus a percentage of funds under management as well. When you run a self-managed super fund, I pay $800 a year to have my fund audited and administered. Doesn't matter if I've got 100 grand in there, 500 grand in there, or $1 million in there. That is a fixed annual fee, as opposed to paying a percentage of funds under management, which means every time I make a government legislated contribution, the guy that I'm giving my money to gets a pay rise. That to me was not a good deal, so I didn't want to have that happen. Those last 2 points are really important as well. You don't actually have to do the administration and the auditing as well. I've spoken to a lot of people about SMSF and they say, oh, I don't want to deal with the paperwork. The reality is, as I say, for $800, my paperwork gets done for me and I sign a few pieces of paper every year. It's actually not that big a deal. It's not that hard to do it. But last but by no means least, there are great tax advantages to superannuation, and it's going to go to 12% of my income whether I like it or not. So I could sit here and say, oh, the super industry frustrates me and I don't like the way they invest, but actually it's going to take 12% of my income for the next 30 years. So I might as well get on top of it and make sure that money is working for me. In terms of concern and a question mark over the way that the big funds invest the money, I think this probably pretty much sums it up very well. This is the investment objective for one of Australia's largest super funds. I won't say which one, but it basically says to outperform after fees and taxes the return of the median balanced fund. Translation, to just be better than average. Now, who would choose to voluntarily do business with a company whose motto was, we're trying to be better than average? No one, right? None of us would actively go, if City Gold Bullion's motto was to just be better than average, that's not who you would choose to buy your gold from. You shouldn't be giving someone a 12% pay rise every year, which is what you're doing under the current structure, when that is the objective of the funds. Second problem I had with it, and what I wasn't impressed with, was this was not how I wanted my money invested. This is a traditional balanced growth fund. I'm not saying it's a terrible investment structure or anything like that, but for me personally, I looked at how they were investing their money and I saw the risk in the equity market, the bond market, property, you name it, and I thought, I don't want 95% of my money concentrated in there. Gold is the ultimate long-term savings asset, and superannuation is meant to be a long-term savings vehicle for us. It made sense to me to have some bullion in my super portfolio, and the only way I could do that was through an SMSF. But last, but by no means least, guys, it basically came down to the amount of money that I realised I could save. And I basically did this analysis, assuming I was 35 years of age at the time, and with my then spouse, the average salary in Australia is $70,000. So I thought, two of us together, that's 140 grand a year. Let's round it up to 150, and let's assume we get salary growth of 2% per annum over our working lives. Well, what will it look like? And let's assume we had $100,000 in our super fund today. We were earning 5% per annum, and as I say, we put 12% in. Well, over the course of our working life, I figured we're going to put $830,000 into super. That is a lot of money. And the average investment and administration fee for a retail fund in the country, last time I checked, was 1.75%. Well, I thought, okay, let's do the SMSF option. Exactly the same inputs, and let's actually spend $2,500 in year one to get the thing set up, and let's spend $1,000 a year in terms of running the administration and the audit for the fund. And let's assume we wanted a balanced fund of some shares, some bonds, some cash, and some gold. You could do that for about 15 basis points very easily. Let's have a look at how much money we're going to save across the course of, by the time I hope to retire at 65. Our SMSF will cost us $67,000. If we stay in a traditional retail fund, we will spend $338,000 in super. Now, I've done this table before, and people go to me, that cannot be right. That's way too much money. There's no way I'm going to pay that much in fees. Well, Rainmaker released a report. Early this year, Rainmaker released a lot of information into the Australian financial services industry, which showed that the average Australian could pay as much as $174,000 in fees across their working life. So you and your spouse combined could very easily spend 350 grand. That number, the 340 that I came up with as an estimate, is a very, very good ballpark of what traditional superannuation could cost us. So there is a huge cost-saving advantage for getting even precious metals and the opportunity to put more money into gold by considering a self-managed super fund. So in summary tonight, guys, I just want to finish with two final comments before handing over. And this first one I think is really, really important. From Sir John Templeton, one of the great investors, philanthropists and businessmen of the last century who said the 4 most dangerous words in investing are "this time it's different." I understand why everybody, a lot of people, want to believe that this time is different and that we can spend more money than we're earning forever and that we can print money. And the fact that that's led to disaster every other time it's been done, it's going to be okay this time. But if history is any guide, and if those words have any wisdom at all, we should prepare for the fact that this time is not different. And therefore, when it comes to gold and precious and physical silver, and ultimately our standards of living, because that's what it's about, it's not really about the money, then we should acknowledge that gold is historically cheap and in the perfect economic environment to rise, that it has fantastic portfolio diversification benefits. It's probably one of the best and easiest ways to protect ourselves from the risks in any other investments that we have, that it is highly liquid and easy to trade in small and large denominations. For me personally, I think it's very exciting the fact that I can purchase it using my superannuation. We have to put money in there anyway. And ultimately, investing in physical gold and silver right now is likely to be the best and easiest way to protect our standard of living through what are going to be some very, very difficult years ahead. Ladies and gentlemen, thank you very much.